So here we are, not even a full week into 2026, and a huge geopolitical event just went down. On January 3rd, the news breaks. Venezuelan President Nicolas Maduro and his wife captured by U.S. forces. And then President Trump announces the U.S. is taking temporary control of the country, and this is the key part, its oil reserves. The media just exploded.
It's a seismic event. There's really no other word for it. And for you listening to this and trying to figure out what's going on, our mission in this deep dive is, well, it's pretty clear. We want to get you past the breaking news headlines. And to do that, we need to look at two things. First, how are global markets actually reacting? Because, spoiler alert, it is not what you think.
It's totally counterintuitive.
Exactly. And second, we have to dig into the history here. The century-long, really messy story of U.S. companies, nationalization, and the economic pressure that got us to this point.
Absolutely, because the first thing you think of is, oh my gosh, gas prices, my portfolio. But the context is everything. So we're really urging caution here, no knee-jerk decisions.
That's the perfect place to start. Because when you look at the data, the market reaction is just not what you'd expect.
Okay, let's unpack that. The capture of a president, military strikes. Expect total panic, right? But Sunday night, Monday morning, January 4th and 5th, global investors just seemed, not perturbed.
That's it. That's the core insight. The market is looking at the potential, not the present reality. The dollar actually moved higher. S&P 500 futures, they climbed 0.2%. And the real shocker, Brent crude oil, it went down, declined by almost 2% at one point.
Wait, why? Why the calm? It sounds like the analysts decided this was more of a political story than a market one, at least for now.
Precisely. And history kind of backs that up. Isolated military conflicts. They rarely cause big, long-lasting damage to U.S. stocks. I mean, the really severe case was 2001, but that was happening right in the middle of dot-com bubble bursting, so the market was already in a bear market.
So the market has this muscle memory for looking past the initial shock?
It does, especially if the event hints at future stability, or in this case, a massive future increase in oil supply.
And you have to put this in the context of 2025, right? Last year was defined by just massive churn. We saw double-digit gains for the S&P 500, but under the surface, it was wildly volatile.
Oh, churn was absolutely the name of the game. The index almost hit a bear market between, mid-February and early April of 25? And remember the Magnificent Seven, that group of tech giants that basically was the market for a few years.
The Mag 7, yeah, that obsession definitely cooled off.
It really did. The performance spread out a lot more. Only two of the Mag 7, that's Alphabet and NVIDIA, actually managed to outperform the S&P 500 index in 2025.
And with NVIDIA, there's a really important distinction there, isn't there?
A crucial one, yes.
Yeah.
NVIDIA was the top contributor to the index's returns, but that's not because it had the best price performance. It was only ranked, I think, 75th on raw price performance.
So its impact was just down to the math. It's so huge that even a small move has this massive multiplying effect on the index.
Exactly. Its size magnifies everything. Meanwhile, if you were diversified, you did really well. International stocks actually outperformed all other major asset classes in 2025.
Which is just a great example of how that volatility can play out over a year. Large-cap growth stocks were on top for 5 months, but international stocks, which only led for 3, ended up winning the whole year.
So that experience with churn in 2025 definitely prepared the market to take this new geopolitical shock, in stride.
Okay, but that brings us to the big question. Why? What is Venezuela's actual influence on oil right now? Why is the market so calm?
It comes down to a scale check. Venezuela today is, sad to say, a marginal player. 50 years ago, it was about 1% of global GDP. Today, it's barely 0.1%.
And the production numbers are stark. The U.S. is pumping out over 13 million barrels a day.
Right. And Saudi Arabia, Russia, they're around 10 million. Venezuela is only producing about 800,000 barrels a day. That ranks at, 17th in the world? So a disruption there, or even a short-term boost, doesn't move the needle that much right now.
But this is where we hit the reserve paradox. Because the current output is tiny, but the potential is just staggering.
Staggering is the right word. Venezuela has the single largest proven oil reserves on the planet, about 303 billion barrels.
More than Saudi Arabia. More than anyone.
More than anyone. But it's potential, not reality. Decades of sanctions, of underinvestment. The infrastructure you need to get that oil out of the ground is it's severely degraded.
Although early reports are saying the existing infrastructure wasn't damaged in the strikes.
Right, which is good news for a recovery timeline, but it doesn't solve the main problem, which is capital. Money.
So what does this all mean for oil prices down the road? Because 303 billion barrels is a number that has to make traders nervous.
Well, analysts are already splitting it into two buckets: the front months and the back months.
Hmm.
The near-term prices, the front months, they won't be affected that much because it will take years and a lot of money to get that heavy crude to market.
So it's like,
Mm,
we're not worried about the price of gas today. We're worried about what it means for 2027.
that's a great way to put it. The estimates are around $100 billion in investment to get production up from 800,000 barrels a day to its potential, maybe 4 or 5 million. So the anticipation of that future supply is already pushing down prices for late 2026, for 2027. It's a long-term story.
And to really get why there's this struggle for control, why these claims of ownership are being made now, we have to go back, way back. This isn't a new fight.
Not at all. I mean, U.S. companies have been there since the 1920s. Royal Dutch Shell built a refinery of Venezuelan oil back in 1916. But then American companies, Exxon and Gulf Oil, they came in and quickly became the dominant players.
And by 1929, Venezuela was the world's second biggest oil producer, right behind the United States itself.
That's right. But then, the tide starts to turn. The push for national control really begins in the 1940s.
Hmm.
You have the hydrocarbon law of 1943, and it did two big things. It set royalties at 16.67%, and it said all concessions had to be returned to the state within 40 years.
A built-in expiration date.
A built-in expiration date. Then in 1948, an amendment required 50% of profits go to the state, the 50-50 split. And well, what's fascinating is that the oil companies were worried this would kill the industry, but production just kept going up.
Which all leads to the big moment in 1976, the official nationalization.
Yep. President Carlos Andrés Pérez creates the state-owned company we all know, PDVSA. And American companies like Exxon, Gulf, Mobil, they had over $5 billion invested. They got back maybe $1 billion each. A huge turning point in the relationship.
And that tension just builds and builds, and then it explodes again under Hugo Chavez.
Right. In 2007, Chavez forces foreign companies to give PDVSA majority control in their projects. Some companies, like Chevron, they agreed. But two huge American players, ExxonMobil and ConocoPhillips, said no, and their assets were just expropriated, taken.
And that history is directly relevant to what's happening today.
Absolutely, because they still have billions in outstanding claims from that. ConocoPhillips alone is owed more than $10 billion. So you can bet they're going to be key actors in any negotiation about the future of Venezuelan oil. This history leads straight into the maximum pressure campaign.
The sanctions timeline here is so important. There were smaller sanctions going back to 2006 for things like drug trafficking, but the big economic ones, the ones that really crippled the country, those came later.
The Trump administration strategy really escalated between 2017 and 2019. It was explicitly designed to force Maduro out. Executive Order 3808 cut Venezuela off from international credit. Then later orders blocked access to U.S. financial markets for the government and for PDVSA. And then the final step, sanctioning the oil sector itself in January 2019.
And that included seizing assets like Citgo, PDVSA's U.S. subsidiary. We all see the gas stations. Its dividend payments were stopped, and the company was put under the control of the U.S.-backed opposition leader, Juan Guaido.
Right. And this is where we get to the two profoundly different stories about what these sanctions did. It's really crucial for you, the listener, to understand both perspectives here.
Let's start with what you're calling the devastation narrative. Some sources calculate that between 2017 and 2024, U.S. sanctions caused Venezuela to lose oil sales equal to, get this, 213% of its GDP.
213%, an estimated loss of $226 billion. It's a number that's almost too big to comprehend.
It's an abstract number, but the human cost was very real.
Terribly real. Before 2017, oil was 95% of their export earnings. It paid for everything.
Yeah.
When that revenue disappeared, the economy collapsed. Inflation hit an annual rate of 344,510% in 2019. A UN special rapporteur also found that even with so-called humanitarian exemptions, the sanctions blocked the delivery of aid, of spare parts, of equipment for basic public services. The human cost was immense.
Okay, so that's one side. On the other side, you have the official rationale from the U.S. government.
Right. And their argument is that these sanctions were a direct response to the Maduro regime's actions, to human rights abuses, corruption, anti-democratic moves, and drug trafficking.
And there was evidence to back that up.
There was. The Department of Justice started a huge investigation into PDVSA back in 2015. They uncovered massive bribery and money laundering schemes. Dozens of people were charged, many pleaded guilty. So from that perspective, the policy was targeting what they saw as a criminal enterprise that was stealing the country's wealth.
And we should remember, this wasn't a static situation. The Biden administration briefly lifted some sanctions in late 2023.
They did, after the Barbados Agreement. But then they snapped them back into place in April 2024, when Maduro broke the agreement by banning opposition candidates.
So this all brings us right back to today, to the capture, and to President Trump's rhetoric about oil. He's saying Venezuela stole oil from the U.S. and that American talent built the industry.
And that's a powerful political claim.
Huh?
But legally.
What's the legal counterpoint?
Well, legal analysts are pretty clear on this. The U.S. has no legal claim to the natural reserves themselves. The companies had temporary concessions to explore and produce, not permanent ownership. International law, specifically a 1962 UN principle, grants states permanent sovereignty over their own natural resources. So Venezuela didn't steal the oil.
Okay, let's look at who's still on the ground. Chevron is the last big U.S. player there.
Chevron is in a really unique spot. They managed to keep operating at reduced levels, even during the toughest sanctions. Their license was briefly revoked in early 2025, but then amended. If sanctions are fully lifted, they're poised to benefit the most because they're already there. But even they admit it will take huge investment. The Venezuelan state companies are, as sources describe them, effectively broken.
And then you have Exxon and ConocoPhillips still owed billions.
They have massive leverage. They're going to be key players in any negotiation about new investment. Their willingness to come back to the table, maybe to get their losses back, could decide how quickly foreign capital returns.
It's also worth noting that just before the strikes, the Trump administration itself was divided on what to do.
Oh, absolutely. There was a clear conflict. You had the hardliners, like Secretary Rubio, who wanted to keep up the maximum pressure. And then you had the deal makers, like Richard Grenell, who were pushing for more transactional deals based on things like migration.
And who won that fight seemed to depend on who had the president's ear at any given moment.
Exactly. Grenell had some early success securing the release of detained Americans, which showed that the transactional approach was on the table. It just goes to show you how quickly policy can pivot. And that's a huge factor now in figuring out how fast this oil recovery might happen.
So let's bring this all together. We've gone from this really weird market reaction, this resilience in the face of a huge geopolitical shock, all the way back through a century of history, and the crushing weight of sanctions on the world's largest oil reserves.
And the main takeaway remains: avoid making any sudden moves. The key factor for the oil market in the long run isn't this week's news. It's the degree of U.S. involvement going forward. And, crucially, how other big oil producers, especially OPEC, respond if and when that massive Venezuelan supply actually starts coming online. You can be sure they won't just sit by and let millions of new barrels crash their price structure without a fight.
Which leaves us with this final, really provocative thought. Given all this history, the instability, the nationalizations, the sanctions that have just wrecked Venezuela's infrastructure, what's the realistic timeline for those 303 billion barrels to actually hit the global market? And will the recovery of that industry, in the end, ever justify the massive human and geopolitical costs we've already seen? Something to think about as this all unfolds.